This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's look at the third stage, the death estate. So this is all the assets held at the time of death at their open market value. We're looking at land and buildings, less any mortgage. There's a note at the bottom that I want to bring to your attention. We'll have a look at in a moment. Any businesses owned, stocks and shares, securities. Now, insurance policy, it's what was received, not the market value. Okay, they may give you two figures in the question if you have to do one of these. Use the proceeds received, not the market value. Cars, chattels, debts due to the deceased. So that could be things like if anybody owes you anything, the revenue may owe you something. Cash and bank, you'll notice it's in liquidity order. Don't worry about that too much. If you get a list like this in the exam question, just copy it. Okay, and there's normally half a mark for copying correctly, so make sure you do. Debts due by the deceased, they've got to be legally enforceable, so not gambling debts. Any outstanding tax and funeral expenses, they've got to be reasonable. Most people have reasonable funerals, but I think you get the idea. Then we take off there any exempt legacies or transfers. Even at death, these transfers are exempt and need to be removed from the estate before we work out the chargeable estate. Mentioned about mortgages. Only if it's a repayment or an interest can you put it in. If it says endowment, do not put it in, because an endowment is like a life assurance policy whereby you pay the lender, the building society or the bank, you pay them back just the interest. And you took out this policy whereby you paid for the policy, and at the end of the term of the mortgage, you take that policy out and it covers the mortgage. Therefore, the capital is then repaid back to the lender, and that's how it works. So actually, an endowment mortgage doesn't actually reduce the value of the property. So only repayment and interest mortgages need to be put in there. That's really important. Only repayment and interest only mortgages. So we have a death estate. What is our procedure? Stage 3. What are we going to do? So stage 1, work out the lifetime tax. Stage 2, work out any additional tax as a result of death. Now, I just want to put a caveat in there. You've seen from what we've done so far that sometimes stage 1 and stage 2 can be quite lengthy. If that is the case, then like the example that we did earlier, there will be a lot of work in stage 1 and stage 2, but the estate will be a single figure on which you have to tick the nil rate band off and work out the tax. You're never going to get a question where you have to do lifetime tax 2 or 3 times. Work out how many of those lifetime transfers took place in the final 7 years, and then do 2 or 3 more, and then do a really full estate. You're not going to get one of those. You'll either get the top half, stage 1 and stage 2 with an easy estate, or you'll get an estate question like the one we're going to look at now, where there was one lifetime transfer, normally a pet, something like that, where you could do it very simply. So it'll be complicated simple or simple complicated. Okay, you'll never get all of it in the same question. Okay, so stage 1 and stage 2, which we can now do. If you're still unsure about that, watch the lecture right to the end and then go back and do them again. IHT takes practice, but the more you do that, they all follow exactly the same procedure. So once you can do it and you've clicked you're looking and you like it, you've got confidence, then you're looking for one of those in the exam because you can answer that with confidence and get lots of full marks. So stage 1, stage 2, we've done. Now we're going to work out the estate. We're going to work out additional things. Residential nil rate band, because that's new on residential properties. Work out the nil rate band and deduct that. Work out the tax at 40% and state who will pay and when. Example number 3 then, Hamish. He died 1st of May 2022. We have here an estate and some funeral expenses. He's going to leave the house to his wife, which will be exempt, and all the rest of it's going to his daughter. One lifetime transfer, cash to his daughter in September 2020 on the occasion of her wedding. Marriage exemption, annual exemptions, all of those things. It is a pet. That kind of needs to be dealt with. Okay, let's have a look at how this works. Example number 3. Get this in the correct order. So the death estate. But first, we need to work out the lifetime tax. So this is step 1. It's actually step 1 and 2 combined, because stage 1, there is no IHT because it's a pet. But we would have annual exemptions. So this is the lifetime transfer. That's from the question. The marriage exemption, the annual exemption for the current year and the previous year because you've never made any. So that would be the lifetime position. Now that becomes taxable because it happened within 7 years of Hamish dying. Therefore, the nil rate band of 325 would have covered this completely, and the daughter would have had no tax to pay. So there's no death tax payable as a result of that. So when I said before, you'll either get a big stage 1 and stage 2 and a little estate, or a big stage 3, which is the estate plus a little lifetime. This is what I meant. But all of this, don't just think that because that's simple, because you could work that out in about 5 minutes flat. That's the transfer of value. We've got a marriage exemption, 2 annual exemptions, take it off, covered by nil rate band. But that's going to get you 2 marks because you know what the transfer is. You're going to get a full mark for that. You're going to get a full mark for that. You're going to get a full mark for that and half a mark for that. Actually, that's not 2 marks. That's 3.5 marks for a working. Please show everything. Now, you don't need to write it out. You could do it in sentences if you would prefer to write rather than do a calculation. Personally, I feel a calculation is much quicker and much easier, but that's going to get marks and it's important that you do it. Okay, so let's go from the question then. Again, make sure you put a heading in. The house, the chattels, the shares, the car, the proceeds on the life insurance policy, less the funeral expenses. 1, 2, 3, 4, 5, 6, 3 marks. Half a mark for each one. Now, the exempt legacy, this is to the spouse. So you're going to get another 1 for that. Nil rate band at the time of death, less what's been used, and that's where your workings come in. So you're going to get 1 for that. Taxable amount, half for working out the tax at 40%. So that's 3, 4, 5, 5.5, 6, 7, 8, 9 marks. So if they add an extra thing, we could get 10 marks. That is a small section C question in full. That's the kind of question that you could get in a section C question. So go back through that again, make sure you understand how we dealt with the small lifetime gift and what we showed, and then the full estate. Estates are fairly straightforward. You basically copy the question in, but obviously what's happened in lifetime in the previous 7 years, that little window of time, will affect how much of the nil rate band there is left to use. Now, there is an additional nil rate band which we need to discuss. This is the residence nil rate band. Now, the rules are fairly complex, but these are the rules for your exam. Okay, this is from 2018, so it's applicable in our year. It's £175,000. Now, it's only available if it's the main residence held within the death estate and inherited directly by the children or the grandchildren, and the question will state whether or not it's available. Okay, that's the one thing. Now, there's an illustration that goes with this to show you how it works. Sophie died in May 2022. She left an estate valued at £850,000. Under the term of her will, her estate was left to her children. Now, these are direct descendants. Main residence, there's one there. Okay, which means that we can have this extra nil rate band. We have an estate from the question, 850. We have the residence is, there's one nil rate band. There's the other nil rate band. So 500,000 of the nil rate bands would reduce that down to 350, which is taxable at 40%. And there it tells you that that's available because it's going. So that's the rule explained in the question, and that's how it is applied